I believe that the real estate capital markets are undergoing a structural transformation. And for the longest time, real estate capital that was being deployed in the private markets came from institutional investors like pension funds, sovereign wealth funds, endowments, and others. And if you were a retail investor, you largely invested in the REIT market. And you had those two, you had this kind of very clear degrees of separation.
Hmm.
I would say now is that is changing materially, and the level of focus in the private markets on attracting retail capital is incredible. And there's pressure on the public markets in terms of, the level of the returns that they're able to generate and how much investor interest they really are getting given what's happening in the private markets. And certainly we can go into the reasons why that's happening if it's of interest. But that shift is significant, and it's something that's going to only accelerate from here. There's also been all over the world, and to be clear, this what we're talking about, Matt, is not just a U.S. Phenomenon; it's a global phenomenon. It's happening all over the world.
Hi, this is Matt Slepin, and welcome to Leading Voices in Real Estate, and welcome to 2026. It's a new year, and I guess it's a new season on Leading Voices. If we think that each year is a new season, the first episode was released back in January of 2017, so we're now at season 9 of the show. Unbelievable. Today's guest is Tim Bodner, the global real estate deals leader at PwC. PwC, as many of you know, produces the annual Emerging Trends in Real Estate report with ULI, which is now in its 47th year. This is our second Emerging Trends show. We had Byron Carlock on the show back at this time of year in 2022, and we did more of a traditional looking forward to the next year conversation. For today's interview with Tim, I wanted to talk less about the coming year, what often shows up in a clock or a cycle metaphor, than in exploring long-term trends and fundamental directional changes. And we try to stick to that throughout this conversation. So the next few episodes of Leading Voices will stick with this theme, moving our lens broad and high to talking about global trends on both the capital side and the investment side of the real estate business. Tim's wisdom and perspective are awesome. He brings a global view on investor drivers, what they're looking for in terms of returns, vehicles, and structure, time horizon, the types of investments, and we also compare investments in U.S. real estate versus internationally, both within the traditional food group asset classes as well as infrastructure and what we used to think of as specialty asset classes. And then the next episode will be similarly themed, but from the perspective of a global investor. It's a conversation with Sonny Kelsey from BGO, exploring the same topics from his side of the table. And then in a few weeks, a conversation with Roy March from Eastdil, a guest I've wanted to have on the show since we started, talking again about these global trends, as well as what's made Eastdil such a dominant player in transactions during the time of his leadership. And since this is my first year of a more relaxed work schedule, ZRG is now calling me emeritus, which is another word for travel boomer bunny. We'll have some interviews from capitals abroad, the first of which is scheduled in Santiago, Chile in March. So stay tuned for more global perspectives on Leading Voices in 2026. Thank you, as always, to ZRG for sponsoring the show. When I sold Terra Search Partners to ZRG back in 2022, ZRG was in the second decile of global talent advisory firms. With the support of our capital partner, RFE Investment Partners, we are now the 7th largest human capital firm globally. We always debate whether size matters, since I know in my work, clients are less interested in the size of a firm than they are in the team they're selecting as their advisor. The beauty of ZRG for me has been the ability to leverage the resources of scale alongside bringing an awesome client-focused team to the table. It's been a great combo now here in my emeritus years. If you're enjoying the show, please rate our show in your podcast app, and please follow and subscribe to the show and share your favorite episodes with colleagues and friends. I keep saying this, but at this point with 220 plus episodes, the library is an amazing resource, especially as a 301 course across the real estate universe. Explore the archives on the ZRG website or on your podcast app and find and share an episode that expands your understanding of our industry. If you have comments on the show or would like to talk about how ZRG can help your business on the talent side, including search, consulting, or advisory in the real estate space, please contact me at mslepin@zrgpartners.com. I hope that you enjoy this conversation with Tim Bodner from PwC, and Happy New Year. Tim Bodner, thank you for being a guest on the show. It is 2025, but it is December. So for us, it's this year, but for our listeners, when they tune in next year, they'll be hearing the beginning of 26. And I really want to think with you, and you're a very special guest to talk to us globally about what's going on. We're at the end of the first year of the Trump administration, so we might know what to expect over the next 3 years, I guess, in terms of global impact. We're hopefully towards the end of a real estate pause or recession in the transaction market in real estate.
Mhm.
And we're at the beginning of lots of really interesting things, and no one that I've met thinks as globally as you do. So that's really the topic of today's conversation.
Well, first, Matt, thank you for having me and for, of course, thinking of us at PwC.
Yeah. Well, I'm thrilled to have you. And you and I got to visit about a month ago in DC. So, first of all, introduce yourself, introduce your role within PwC. What do you do for a living? What does PwC do for a living in the real estate space? And then let's jump into all the conversation.
Yeah, happy to happy to start there. So first and foremost, I live in Washington, D.C. I am by day, I'm a client service partner. So my highest calling is to serve our clients here in the United States and around the world. I also have oversight responsibility for our deals business globally, which includes the US. And as part of that, I actively coordinate our broader real estate activities across the network as it relates to the US activities, which also covers things like tax, our assurance business, some of our specialties businesses, and our wider advisory business.
Uh-huh. And what does the global deals business mean? Because it feels like everything's a deal. And then what does the global role mean? And are there other practice leaders that you're peers with who together you're running everything that PwC does in real estate?
That's right. So the easiest way to kind of think about our deals business is very much our investment banking business, with the exception that we don't have a balance sheet as a firm, and there's certain other things that make it different. But from a very simplistic perspective, that's how I like to think about it. And so what we're doing is we're working with our clients, which include private equity firms, sovereign wealth funds, family offices, endowments, pension funds, real estate investment trusts, service companies, corporate occupiers on transaction related matters, which could include mergers and acquisitions, capital raising activities, and other strategic events. You are right that I am one of a number of leaders who collectively look after our real estate business for PwC. And so there's colleagues and partners of mine who look after our audit business, our tax business, certain parts of our specialties business, and we collectively work together to run the business as a team.
Mhm.
There's also a number of other individuals who help at a global level that sit in places like Germany, London, and other places around the world.
Okay. And when you and I spoke last time, one thing I love to talk about is business platform. I think a business platform is the opposite end of the spectrum of deals,
Mhm.
but you had a whole lot to say about business platform. So you think holistically about the business with transactions as a part of that. And then also the other thing that I found fascinating in our conversation was how much you're traveling and listening to others around the world about maybe capital flows. Talk
Mhm.
about the rhythm of of your job
Sure.
in addition to the role that you have locally with your clients.
Yeah, so a couple comments to be responsive to your question. First and foremost, you'll like to think about what we're trying to do here in terms of creating outcomes for our clients that result in sustainable value creation. And certainly transactions are part of that. But there's also a lot of other things that go into it. And that is one of the kind of what I view as a differentiator for our business overall is that we can provide end-to-end solutions that generate material outcomes. To do that, one of the things that's very important to me and to my partners is that we need to meet our clients where they are, and our
Hmm.
clients are global in scope. They have people all over the world. They're uh, running their business across Europe and Asia and the Middle East and South America, and they allocate capital globally. And so for me, it's really important to understand what's happening. And that's why after we met in DC, I had just gone back from a trip to Switzerland, Norway, France, and Singapore. And the what I learned on that trip was just incredible. And it just makes us, I think, better business advisors when we're able to kind of connect the dots around the world.
I think we're going to get into some of those learnings through the conversation. So I don't want to use that as a teaser to jump into that. But I also think you were on your way to Asia the next week. So
Cool.
the kind of those the perspectives of sitting here and being at those two areas of particularly capital formation is really important in our industry. And it's a view we never get to talk about.
So I think on the capital flow side, what I would say, Matt, that I spend a significant amount of time thinking about is that I believe that the real estate capital markets are undergoing a structural transformation. And for the longest time, real estate capital that was being deployed in the private markets came from institutional investors like pension funds, sovereign wealth funds, endowments, and others. And if you were a retail investor, you largely invested in the REIT market. And you had this kind of very clear degrees of separation.
Hmm.
I would say now is that is changing materially, and the level of focus in the private markets on attracting retail capital is incredible. And there's pressure on the public markets in terms of, the level of the returns that they're able to generate and how much investor interest they really are getting given what's happening in the private markets. And certainly we can go into the reasons why that's happening if it's of interest. But that shift is significant, and it's something that's going to only accelerate from here.
Hmm. So let's put a pin in that one and come to it in a few minutes because it's a dangerous one. I have a few more global questions just to understand kind of your role and where you're coming from, so our listeners understand your voice.
Sure.
One thing is that PwC does the annual emerging trends study with ULI, and you and others go around the country talking about this stuff. We had Byron Carlock on the podcast either 3 or 4 years ago, after in the middle of emerging trend season, but it is emerging trend season. What does that mean for your outlook and how you approach what we're going to talk about today, but also in your business?
Yeah, well, it's accurate to state that we have a long history with the Urban Land Institute. It's also accurate to state that we have been publishing emerging trends in real estate with ULI for over 40 years. And we do that here in the Americas. We do that in Europe. We do that in Asia. And then every March we do a global overlay. And what I would say, Matt, about that is it really enables us to be in a very privileged position because we, through that process, talk to thousands of people and businesses all over the world about what they think is happening for the next year. And then we're able to kind of step back and stare at what we learned and put together a publication that is, from our perspective, one of the most sought after and widely read publications out there for forward thinking trends on real estate. So it's a terrific opportunity for us. It's very important to us, and we spend a lot of time on it.
Yeah, and it's available on ULI's website, so everyone can get it if they haven't seen it. Who's listeners? ULI started this podcast 8 years ago, so no longer behind the podcast, but they're in my mind all the time as we talk about this stuff. But it's interesting and something I'm going to want to shift the lens on this conversation from the every year report, which after I read it for about 10 years, I like stopped reading. I don't like every year things because I like what's the wisdom of the last 10 years and what's the change to this year or the ongoing outlook and what's the 5 or 10 year, what are the shifts, not the fads. And
Right.
so I think today we're talking about shifts in conversation, and you have the wisdom of being able to look backwards more than most people do because you have the sequential document.
That's that's right. And what I would say, Matt, on this is, to your point you mentioned, some of these trends, moved in the past slower.
Hmm.
Today, things are moving much faster.
Right.
And the degree of which things are changing and industries are converging, capital is changing is quite significant. So I think this is actually a really unique opportunity to talk about where we think things are.
Yeah, and one other view into that, which is interesting. I go to the a conference where Ken Rosen is the host and speaks twice a year, and I've seen this clock that he has. You've all seen the clock, and the clock assumes that the entries into the clock are always entries, right? So we're looking at, okay, it's 10 o'clock for something, it's time for it to go down, but it's only 6 o'clock, so it's going to go up. That's really cool, but this sector has left the clock, or this sector moves at a slower pace than the other sectors, or this sector is in a 15-year decline, whatever that is. And that view is missing from the clock view. So today's conversation, I think I want to stick not to, hey, what's the clock? What's hot for this year? What markets are hot for this year? Is Indianapolis hot or is Philly hot? But
Yeah,
what are the long-term meanings of this? And so let's go to the place that we want to put a pin on and talk about those global capital flows.
yeah,
And with retail investors coming in, and their place used to be REITs, but now they have more places. What's that mean for REITs? Because I always wonder about that. But then what's that mean for the rest of the capital flows coming into real estate? And where will that flow the capital to? And
sure.
what's the behavior of that capital? Is it longer term thinking, shorter term thinking, global, local, regional? Go for it.
Let me start by framing how I think about what's happening in the retail market and why it's happening. So, number one, if you look at this at a very macro perspective, people in general are living longer, which means that they need savings to live on for longer periods of time. And when you take a step back and you stare at the structure of the retirement system, it's very much today set up in a way to accumulate assets. But the products that are available through the decumulation phase are really not there. And so you have this challenge where people are living longer, they need money to last longer, and they need products to be fit for purpose, and that hasn't happened. And what that's meant
Mhm.
is that there's been an incredible uptick in the volume of annuities that are being sold all over the world by insurance companies. A significant portion of that is moving into the private markets and into real estate. So that's the first thing.
Mhm.
Second thing is, and it's been getting a lot of airtime lately, but there is, a significant effort underway to enable the defined contribution plans, so the 401ks, to be able to invest in the private markets. The reason for that is that the returns available in the public markets are increasingly concentrated. And so if you're an investor and you're trying to diversify and have a sustainability of returns, you need other options and the private markets are part of that. So that's a reason why it's happening. There's also been all over the world. And to be clear, this what we're talking about, Matt, is not just a US phenomenon, it's a global phenomenon. It's happening all over the world. There's also a shift from the defined benefit market to the defined contribution market, and more of the onus of the burden for generating returns is moving to individual employees, and the defined contribution market is one avenue available to that. So there's a big proliferation of capital that's being pointed at the retail market, and that's why we're seeing a lot of private capital firms investing heavily in building products that meet these clients where they want to be met.
Mhm.
Now, terms of what it means for the public REITs, if you stare at the last 10 years, and we can get into certainly some of these statistics if you think it would be helpful, but the returns that are being generated by the public REITs are predominantly coming from the top 40% of the public REITs that are out there. And if you look at the bottom half of the public REITs that are out there, they've actually generated negative total shareholder returns over the last 10 years. And so what does that ultimately means? It means that to generate returns from an investor perspective in the public markets, it's really the largest REITs that are going to attract all the capital. And there certainly is a size premium that we see in the market. And so that's effectively resulting in the smaller REITs that don't have as much scale not having nearly as much liquidity. And so that gap is being filled through these other alternatives in the private markets.
Hmm. So you see some consolidation coming in that sector, just if we're thinking of deal flow, but also operating platforms that will become stronger. Size matters more than it used to.
For sure. We just came out with our this week actually we came out with our 2026 deals outlook for real estate and real assets. We cover this very clearly there. Yes, we see significant consolidation in the public REIT market. We also see consolidation in the private markets too. So it's not just a public market phenomenon, it's also a private market phenomenon. But yeah, we do believe we're at the leading edge of a rapid consolidation cycle in real estate and real assets.
Mhm. And small doesn't work, but large works better, and therefore business platform and the efficiencies you can have, which we never had before in real estate or in commercial real estate, that really does drive long-term stability and long-term returns from your perspective.
So for the longest time when we did public to private transactions or public to public transactions, there was always this discussion around how much platform value really was there and would anyone really actually be paying for that perceived value? And the answer was always there isn't, and no, nobody was paying for it. That today is changing. And so to your point, Matt, we do see and are very focused on drivers of operational value creation. And the reason that's why that's more important today than it has been from our perspective and my perspective is because cost of capital is structurally higher and you're not nearly getting the uplift that you had been getting from cap rate compression or multiple expansion, whichever way you want to frame it. And so you really do need to have a proper business plan and view on how you're going to generate value through ongoing operations. And to your point, that is increasingly happening at an overall platform value, not just at an individual asset level or portfolio of assets.
Uh-huh. I had Don Wood on the podcast a couple weeks ago when we talked about this, and we talked about it in the retail sector. And one of the comments I made to him, which I think is relatively true, is in the traditional food groups of real estate, like retail or like multifamily, like not maybe not industrial at this point, but in these sectors, the 4, 5, or 6 major REITs tend to trade as a block, not to there's no premium for which one's better than the other one in terms of business platform. But in the specialty asset classes, there is more of a premium. Is that true? And what does that mean?
So I think the way I think about this, Matt, is that it is really hard to see the difference in a lot of the existing public REITs within the same sector. You know, oftentimes, the discussion has been we need more of these REITs because they focus on a particular niche. They focus on a geography or they focus on a particular type of sector. I think because of the point I made before where you've got all these things converging,
Hmm.
I'm not so sure that those matter anymore as much to investors. And I think that's part of the reason why you're seeing what you just saw, which is that you're seeing groups of these businesses that are being viewed as being in the same sectors trading in the same way. And that's not just true in retail. I was on the phone with a multifamily REIT CFO this week, and we had the same discussion. Everyone in
Hmm.
that sector is trading at a discount.
Well, it's okay if they're trading at a premium as a group, but if they're trading as a discount in a group, there might be a problem.
Yeah.
So the importance of business platform, a crowded space, importance of size and scale, but we're actually talking about capital flows and retail investors coming in. So there's
Mhm.
the question about the REIT. What are the products that they want to come into that works for those investors, either public or private, and how will that change the business over the next 5, 10 years?
Yeah, it's a really important question when we think about investment structures. I mean, for the longest time, particularly in the private markets, you had closed end opportunity funds and you had open ended funds in the
Yeah.
private market. And then you had public REITs. 8 years ago now, we started in the private markets introducing version 2.0 of the non listed uh, REITs, which folks will understand have been around for a while, but it wasn't the right product market fit. Those products were not necessarily designed in the right way. They had higher fees. They didn't have the right level of institutional support. And so version 2.0 was intended to address that. And we saw an incredible uptake by private markets.
Blackstone, the B REIT, and
People like
others.
and they did phenomenal. And it's a great product. What happened there was, we obviously had COVID come, and then we had a sharp uptick in interest rates. And, retail investors tend to, change views more rapidly than institutional investors. And so a lot of that capital exited. And so there was a lot of question around, was that product, truly set up in the right way? I and we would argue that yes, they were set up in the right way. They operated exactly as they intended, and they're by definition they're always going to have limited liquidity, and so there's going to need to be some kind of orchestration around how redemptions were queued. But that was always part of the project. Interestingly enough, as things have move further down the track here and
Mhm.
more retail capital is going into these markets, the products have also had to evolve. And so you still, of course, have, the version 2.0 non-listed REITs out there. They're doing very interesting things to try to facilitate capital formation at an accelerated pace, thereby including things like Delaware statutory trusts, which is a very technical tax structure. But they're doing interesting things to try to facilitate more capital in that market, while at the same time also introducing new products, things like interval funds and the like that have different regulatory characteristics than a non-listed REIT, that are conducive to investing and meeting these investors where they want to be met. So it's not that we don't still have capital going into opportunity funds. It's not that we don't have open-ended funds anymore. It's just the product set is widening based on what the investors are demanding.
And so if I think about that, does that mean more closed-end funds would and closed-end funds were there were some historic open-end funds in the
Mhm.
Odyssey Index, and then a lot of closed-end funds. Everyone wanted to do value add in and out, 3 or 5 year period of time. And then there's become some more open-end funds, and then there's these private REIT 2.0. What does that mean for the time horizon? What does that mean for will investors want to go into allocators who will wisely put them in multiple places, or will they want to go into thematic investing for this? Do they want to cut out double promote? What do those investors want to do, and what will that mean for the structure of what our industry has to put together for these dollars to be used wisely?
Yeah. So another really important question, and to be clear, the opportunity funds that are out there are very much still going to be part of the rubric. In fact, we've seen some firms, raise the largest opportunity funds in the sector that they've ever raised. And so there's certainly going to be investors from the traditional institutional markets who are going to continue to want to invest in those products, and they'll still be comfortable with the traditional hold periods.
And when you say opportunity fund, that means closed end, and that means higher yield funds. I actually don't hear the word opportunity fund as much as I used to, but it's mostly institutional investors who will play that game.
That's right. Yeah, closed-end funds that have an opportunistic tilt
Yep.
to them, and certainly, sometimes, the line that's blurred between that and value add is a little bit murky, but yes, the word I'm referring to the closed-end funds. On these new products, that's where you do see the time horizon lengthening, and that is kind of an interesting business model change that's happening in the private markets, where you have all the whole period lengthening, which also changes the business model for the sponsor of those products. I think what's also going to be really interesting, and we can talk about this if you'd like, the way that closed-end funds typically work is they invest in an asset or a company, they hold it for 5 to 7 years, they run their business plan, and then they exit through a private sale. Or if it's a scaled business, traditionally they went to the public markets.
Hmm.
As you see time horizons lengthening, what does that mean in terms of the overall exit environment and the transaction market? And in addition to that, what does that mean in terms of the IPOs? I mean, the last significant IPO we saw was in the cold storage space in 2021. The last time we had one before that that was, of significant scale was in 2017 in the single family rental sector. We haven't seen that many. And so I think there's a really interesting business model change happening structurally in terms of how do some of these private market participants exit these investments over a longer period of time, which is probably somewhere like 10 to 15 years is where some of the time horizons are moving towards.
I do a lot of work in the affordable housing space. In the affordable housing space, we, if that's the right word, we want longer term investing horizons for a very stable asset. And if it is indeed a very stable asset, that might mean stability, but a lower return, but a predicted lower return for longer term capital that also then doesn't require people to buy and sell, buy and sell, buy and sell, which has a lot of frictional cost and frictional risk and isn't the best for the residents of that asset class because it puts pressure on that might not need to be there otherwise. Does longer term capital apply in those cases and in similar cases of other asset types?
So this is a really interesting point to move towards. And I think what we can think about here is, what is the definition of real estate? You use the definition of affordable housing. If I think about the way that's viewed globally, some people would actually look at affordable housing as an infrastructure investment,
Hmm.
particularly in Europe, as an example, but not just in Europe, in general. And so I think there's a discussion here around, is it really real assets is the point, because of this convergence between real estate and infrastructure. And the reason why that point is important is I think it gets directly at what you just said, which in general,
Hmm.
infrastructure investments historically have had a longer time horizon, more predictable returns that in general have been lower than the returns that have been generated through closed-end real estate products in the past. And we've already seen a number of market participants making this change to more of this real assets banner, and we think that's going to accelerate too. And a lot of it's because of what you were just focusing on in terms of the time horizon and threshold
Hmm.
return.
Hmm. In affordable, we're going to have a conversation with Vistria that's raised a lot of money as against that model. And if you take out the risk and you take out the amount of trades within real estate and accept it as more infrastructure, maybe for the major food groups, and the returns come down or the return requirements come down for those assets, that may also reopen some of the trading volume that we've had so low in the last couple of years.
Well, I think the other thing that's really important, Matt, is oftentimes when we have discussions around the state of the transaction market, the discussion focuses on the traditional asset classes: retail,
Hmm.
multifamily, logistics, hospitality, etc.
Right.
We've increasingly seen as what's considered to be actual real estate has been broadening for some period of time. And the next iteration were things like senior housing,
Hmm.
storage, student housing. But now we're seeing it broaden even further, and you're seeing a tremendous amount of activity in cold storage. You're seeing material activity happening in sectors like marinas. And I know we're likely going to get to this because it's the question: is your data centers
Of course.
and digital infrastructure.
There's a pin in that one. Yeah.
But we're also seeing things around manufacturing facilities, semiconductor facilities. I just did a event this week on sports and live entertainment and mixed use real estate development in that space. So, what's considered real estate is much broader today
Mhm.
than it is in the past. I think that's real, and one of the reasons why why that's happening is because of what we're talking about right now, which is how do you generate returns over the applicable time horizon, and how do you weave in operational value creation? Some of those sectors I mentioned are more set up to do that, and I know we might get to that, but I think that's another interesting point to focus on when we have this conversation.
Yeah, it's funny. The first time I thought about this, there was another podcast at the end of the year with Chris Hartung
Mhm.
and Mike VK, and we were talking about the REIT world again. And when we went back to the REIT world, Chris said something that I wasn't then aware of. He said 60% of the NAREIT index are what we would consider specialty asset classes. That's probably increased over the last 4 years and will continue to increase as you're describing it. So maybe much of that investing is in niches. And if you look at the niche as more infrastructure and therefore longer term, and then maybe lower risk adjusted returns as well, that might bleed back into the major food groups in terms of the whole industry changes and moves over towards where infrastructure is in terms of return expectations and stability.
So if I go back to the way you opened this, and I think
Yeah,
about your point that we don't want to just focus on, what's happening in the next 6, 12 months.
right.
You At our European real estate conference about a month ago, and we were having this conversation with a panel, and one of the panelists referred to these as niche, right? Which are
Mm,
introduced in your comments there. I think if we look at this over 10, 15 years, to the point you just made at the end there, these are not going to be niche.
mhm,
This is where the world is going. And to your point, maybe we won't call it infrastructure, we'll call it real assets, but the point's the same in that the return thresholds are different and the time horizons are different. There's also really important implications around how you think about running a investment business in that environment. So for example, you mentioned the Odyssey index before. When you think about the benchmark of the Odyssey index, that doesn't include a lot of these alternative asset classes.
mhm,
And so the whole benchmark of what's that you're measuring against needs to evolve as well to be able to be aligned with where the asset class or where investors are actually going. There's also really important implications on human capital. So you run a human capital business, but what types of skills do you have? What type of talent do you need? How do you develop them? How do you get them to think more operational in nature? There's a lot of really important business model implications from all of what we're talking about here too that we're spending and I'm spending a lot of time talking to people about.
well, I next want to talk about global, but I want to go back to this one because I won't put a pin in it. I'll say it since I'm a human capital person. It's like, let's play it out in the multifamily business. And the multifamily business, with the evolution of the business platform and the breakup of what had been a 40-year way of operating apartments, very hierarchical, very locally based, and very property based, that's changing. And as that evolves, the human beings who run different parts of that business have changed in a meaningful way. And they can come from other sectors, but someone to run a call center for multifamily is someone to run a call center. We never had a call center, let alone a person who knows how to do that. And that does not have to be an apartment person, right? There must be like 5 or 6 kinds of people who run call centers, maybe B2B, B2C, whatever it is. But that becomes fascinating and will change our industry. So
We totally
really
agree.
important.
And I think it gets right at the core of this the convergence of all these different industries and the mindset that you need to have is changing significantly. And so I think as you said, it is going to be fascinating to see how watching for somebody that in the human capital business, it's a
Yeah.
very time to be in the middle of it.
Oh, it's great. Let's play the convergence for a minute, and then we're going to go to global. But the
Okay.
convergence thing, One word that comes to my mind that has been important for all of the property sectors has been the hospitality mindset and the customer-oriented mindset, and we used to not think of it that way. Even in the office sector, I remember, like, they're gonna get me into a box up in the air somewhere, and that's what, it is, and they're gonna show up, they're gonna come no matter what. No, it's become a hospitality business or else people won't come to those places.
So it's such a fascinating conversation that I was with the head of strategy of an office REIT actually this week for lunch, and we spent a lot of time talking about this and how at the end of the day what happens inside the four walls is that means everything. And to your point on the hospitality mindset, that gets at the heart of amenities. And the fascinating conversation we had was, well, what are the most important amenities you need to have in an asset today? And we had gotten to this conversation that, from his perspective, and I've heard this from others, the top two that you need to have is you need to have more conference space
Mhm.
and you need to have more wellness and fitness attractions. I thought that whole concept of more conference space is really fascinating to think about. And the reason why it gets into, maybe what happens with AI and further technology evolution is that a lot of work can be done through those means. And so what actually when actually you're going into the office, what you really want to do is you want to collaborate. You need to
Mhm.
collaborate. You need to kind of sit around the table, look at what you came up with and figure it out as a group. And so that puts much more importance on having conference space and meeting rooms versus separate offices. In fact, he was telling me that in their office, they're actually taking out a lot of the commons areas to add more conference rooms because that change is so important to their business. So totally right. It's all about what happens inside the four walls, and that is very much a hospitality mindset.
Huge, huge. So I promise, let's talk about global capital again. So we're back to global capital and we're back to these investors, and investors don't necessarily know borders. And we've always been US centric. I've been US, I live in the States, but also we're this country, right? So it's America. We're pound our chest. Everyone wants to invest here, but maybe not now. So the desire to invest here has changed a little bit, and some of the barriers to invest here might have changed a little bit, but also there are other opportunities that may be more attractive over time. So as these global investors think about all of the things that we've talked about, does that increase capital flows to the real estate world that as we know it in the US? Does it decrease? Does it democratize it around the world? Like, how do they think about it? Meaning investors from outside the US. How do we as investors inside the US think about it? And what does that mean?
So number one, capital flows are very much still global, right? And so, there are certainly some cohorts of global investors who have pulled back on allocations to real estate and real assets. Some of it's due to just where their allocations are today and also the level of concentration they have in certain sectors like office. And so it is true, and that oftentimes gets highlighted. But what is also true is that there's some global investors who've been quiet for a while on real estate and real assets who are coming back in a much more significant way. You could think about what's happening with some of the investors from the Nordics as one example. You can also think about some of the investor groupings from places like Australia. And so it is still a very true statement to say that real estate capital is global and investors are looking at things from a global perspective. Why is that? At the end of the day, investors have a fiduciary obligation to generate returns for their investors, whether they be institutional or retail. And so they're looking at investment opportunities around the world and where do you see the most attractive return, where do you see where the most attractive returns can be generated. And increasingly, that's not in the US. So, for example, there's been a lot that's been happening in Europe. There's been a significant amount of activity in Japan. There's been significant activity in India. There's been significant activity in the Middle East. There's been an uptick in activity in Australia. And that's the reason why that's happening. Now, does that mean that the US is not attractive? No. The reality is the US is the largest market in the world with the most liquidity. And so if you are a global investor, you're going to continue to allocate capital to the US. Now, maybe at a lower level or a different level, but it's still going to be part of the rubric going forward. And we don't, and I don't believe that the discussion around it being reduced is an accurate portrayal of what's happening on the ground. The final point I'll say on this is that when you look at some of the other things that are happening in the global economy around public policy and the like, there's also a lot of capital demand being generated through those initiatives around investing in things like supply chain, new supply chain assets, and that includes things like data centers, but it also includes power related assets. It also includes things around semiconductor manufacturing facilities and other manufacturing facilities. And so there is a lot of capital being generated in that regard, including here in the US.
Uh-huh. So when you talk about this and you say, hey, this is what capital wants to do, you speak of it almost personally when you said the Nordics. I'm thinking of sovereign wealth funds in those countries, and I'm back to institutional investors versus retail investors.
Mhm.
So the first part of the conversation is retail investors are coming in. We don't necessarily have a proxy for talking to a human that represents all of them together.
Mhm.
So think through what works for the sovereigns who are very sophisticated investors playing around the world. Think through what this group of retail investors who will all act independently, what's best for them. And I'll come back to a risk question about them. And then think about that again globally versus the US perspective. And one last comment, I'm making this too long a question, but if I think of a sector, like let me think of industrial or logistics, and let me think of data centers, maybe all of a sudden the minute I think about data centers, I go, okay, where do I want the data center? And maybe that data center could be in Norway as much as in the US, because I'm thinking about it as a strategy from the sector, not a strategy from US data centers anymore.
Well, listen, the the Nordics are in particular an area of increased focus around data centers and digital infrastructure for the reason that the climate requires less cooling to happen because it's just where
Cooler.
it's physically situated. It also is true that in places like the Nordics, their access to differentiated power sources is much broader, and it also happens to be more sustainable in some cases.
Mhm.
So there is a lot of activity happening in the Nordics around data centers, but it's not just data centers, it's broader than that too. Now, to your question about how do I think through the difference between institutional investors and retail investors as they invest globally, I think it has more to do with the product than what the underlying investment is. So what I mean by that is the whole periods are different, the liquidity considerations are different, the size of the investments are different. And so that's I think where the product becomes really, really important. And so then the question is, how do you structure a deal where you can invest in something like a data center in both places? Because it is very much the case that retail investors want exposure to digital infrastructure in the private
Mhm.
market. And
Mhm.
so I think and we've seen this happening at varying paces over the last 5 to 10 years, but there's also a lot of collaboration and crossed investments between different products, right? And I think we're gonna see more of that. Just when what I mean by that, I think it would be we'll see more investments from closed-end funds and something like a non-listed REIT than we've seen in the past. I think we'll also see more crossover with things like infrastructure funds and other funds as well because of this phenomenon. So I think it's almost like how do you take an opportunity and fit it into the different pools of capital that you
Right.
have? And we've seen this in some cases in in a big public to private transaction, this cohort will go to this pool of capital, this cohort will go to this pool of capital, but it'd be one transaction. It just where the capital comes from is different. I think that's what we're going to see more of.
And the different pools can come in. It's funny, and we're only going to get to scratch the surface because I have more topics here. But scratching the surface on how will the product change, and product does not mean sector and doesn't mean real estate. Product means the investment product into which it's and the structure of that investment product and the time horizon and the return expectations and liquidity and all of that in that product. And I think what you're suggesting is more change coming, and the locked in 3 or 4 products that we've been using for the last 20, 30 years are going to keep changing.
So one way to think about it, and I oftentimes reflect on this, is it's really what's happening. But at the end of the day, are these businesses really becoming wealth management businesses?
Hmm.
And so we also just issued our deals outlook for the wealth management subsector this week as well. And we've seen a material increase in the level of wealth management transactions. And the reason why that's happening is there's this proliferation of retail capital. We've also seen, Matt, among market participants, an uptick in level of interest in buying more wealth management platforms to expand distribution. Like, so I think you could look at this and say, at the end of the day, back to this topic of industry convergence, are these really all just becoming wealth management platforms with customers that include institutions and individuals?
Hmm. Hmm. What I hope for the investors, if the retail investors are coming into our business, it used to be buyer beware, and you can't be buyer beware to that degree anymore. Now, you can't totally protect people from cycle change because cycles happen. There's ups and downs and volatility that way. But the volatility of product type should go down in that world. That's
I
going to
agree.
matter.
Yeah, and I think your point, I would agree with your point on it's not buyer beware. And I think the industry is aligned with that. If you just take a macro view of this, the amount of time, attention, and resources, financial and non-financial, that's being spent on investor education is the greatest it's ever been. I mean, it's fascinating to me the number of emails I get from these different market participants around just trying to educate the market around what they see, why they're allocating the capital, where they're allocating it, what do they see as the risks, why don't they see risks in a particular spot. And I think that's only gonna, to your point, to not be in that buyer beware mindset, there's gonna be a lot of continued attention around investor education.
Yeah. Well, fiduciary who to trust. So I want to go back to the global question, and I want to put a little bit of a political bent on it. At the
Mhm,
beginning of this year, which was the beginning of the Trump 2 administration, so many questions about immigration, so many questions about tariffs. And many of those questions, I think, then had people say, I'm going to invest in my own region.
mhm.
Europe gives itself a bear hug. Asia gives itself a bear hug. Asia wants to come give a bear hug to Europe because we're less friendly with them. And the US was always the stable and safe haven.
Mhm.
Those rules have changed either temporarily or permanently, I don't know. And we're anti-globalization, but that's crap. It's not anti-globalization. Every part of this conversation has been we're more global than we were before. So address those things together a little bit so again I can understand how people think about the risk and capital flows, the meaning of the tariffs, the meaning of immigration that we have here as against that.
So at a overall level, what I kind of think about when I look at all these different things that you mentioned, why is all this happening? The reason why it's happening is because it's been viewed that the playing field is not uh, fair or aligned, and so that there's places outside of the United States, for example, that have done various things from a policy perspective that have put, from the U.S. perspective, us at a competitive disadvantage. And so the focus is on not deglobalizing per se, but it's to align the playing field so everyone's playing by the same set of rules. And I think that gets to your point on one of your points on the tariffs, for example, where listen, the U.S. And to be clear, this is not a new issue. And in fact, this goes all the way back to the days of Thomas Jefferson. As when all this started happening, I became a student of history here, and this is going back hundreds of years. This concept of how to use tariffs. So it's about leveling the playing field. And I think it kind of started out the way it was in order to kind of get people to the table. But what we've seen consistently over the last year is those tariff levels come down and more deals be reached among different countries around the world. The last one that I think about is the deal between the US and Switzerland as an example,
Hmm.
but it's much broader than that as it were. And so I think it's not that tariffs aren't important to market participants. They certainly are. They're still a consideration, but I think people have more visibility into where this is going. And the mindset is shifting to how do I run my business in this new environment that I'm part of? And so that's where I think on tariffs. If you think about immigration, listen, it is a significant consideration across, we see it across sectors in terms of what it means for labor availability, particularly in certain areas of the economy, certain activities, what does it mean in terms of wages? And I think over time we'll see what happens to policy in that area, but it is a consideration for sure. And I would say it's probably from the conversations that I'm having is in front of the tariffs at this stage.
Hmm.
The other one you mentioned there was tax policy. Listen, I think on tax policy we're actually from an industry perspective we're in a pretty good spot.
Hmm.
The one Big Beautiful bill when it
Good
was
for.
enacted, I think people focus on what it did do. I think what oftentimes what I think about was what didn't it do? And so it didn't bring carried interest into the conversation. It didn't bring uh like kind exchanges into the conversation. And I think on one of your shows you had, Jeff DeBoer on,
Hmm.
uh and Jeff and his team, at the real estate roundtable were, an instrumental part in making sure that the views of the industry were fully heard. And so I think that actually we're in a good spot from a tax perspective. And there's no other things that are being worked on that would also be helpful. So, for example, if you think about global investment, which I know you want to kind of spend a fair amount of time on, there's a lot of things being done on the Foreign Investment and Real Property Tax Act to address certain items that would be more conducive to accelerated global investment. So, I think on the tax side, we're actually in a pretty good spot from a
Yeah, we
policy.
probably are. Interesting editorial this morning in the New York Times from Mitt Romney, who went after carried interest. I don't know if you saw that one, but it was like, okay, it's back.
It comes up,
It
and again,
always will.
it's gonna keep coming up. Yeah.
So, but let's go back to when you talked about tariffs. It's a forever issue, and then you use the word deal, and the word deal is a word I don't like because deal suggests something temporary, not temporary, at this moment versus something that's permanent. So when this settles back down into a new world order, we've had a world order for like 40 years. Right? We had
Mhm.
predictability. We know what the rules were. It may have not all been fair or aligned, but it was stable. When we get back to a place of stability, I'm going to bet that the capital flows will have the US being less of the standard place where 40% of capital goes or whatever it is into being more balanced around those major developed parts of the world. Is that a fair statement?
So I think when I think
A
about
fair
this,
guess, sorry.
well, I think I look. There's always in going back to our emerging trends in real estate publication that you talked about. The theme this year is the fog of uncertainty. At what
Mhm,
level do you have? I always kind of look at it as we've always had uncertainty. In the operating environment, it's one of the things that I always sit and reflect on and have admiration for how real estate and real asset market participants have always found a way to get through this fog of uncertainty. And so I think it's always been there. Now, I also think it's true, Matt, to say that we've always the global economy has always been evolving. Always. It's
yeah.
been it's evolving. Now, I think what's different this time is it's being done in a much more visible and aggressive way than it's happened in the past, and it's being driven by somebody, or by the United States that is doing it in a that's very visible just by definition. I think that's the difference. But I
Mm,
remember back to you just think about when we were talking about, the bricks, right? 20 years ago, 25
right.
years. I mean, there's always these structural issues happening. I think it's just more visible this time, and so I think we're gonna have to continue to and we're gonna continue to see that. So I think it's much more a mindset thing is how do we just adapt our businesses to be more resilient and agile despite all these changes that are happening, and that I think is just a mindset difference than something that now final point is, what do I think it means in terms of the United States and global real estate investment? As I mentioned before, at the end of the day, the US is still the largest market in the world.
Hmm.
And the growth that and the level of returns that could be generated here are still very, very significant. And so I believe that over time, long periods of time, which I know is kind of how we wanted to focus,
Yeah.
that we're going to continue to see, meaningful levels of investment into the US economy, which includes real estate and real assets.
I think that's a truism. I'm pushing this towards, does the world change in some way? 20 years from now, will the flows be on a percentage basis different? But absolutely, we're the largest market. Absolutely, investment will still come here. Maybe the percentages change a little bit over time. So that
I think
makes
that's
total sense.
no, I think that's totally fair. I think the percentages though, are going to be, at least the way I think about it, are going to be reflective of just the absolute size of the investable universe. And so I think for other places to, increase their share, I think their overall investable markets going to definitionally need to grow in a material way. And look, and then to your point, which I agree with, we're already seeing that in India. So we're
Hmm.
seeing that for a while. We're definitely seeing it in the Middle East. You just think about the amount of capital going into the Middle East from all over the world as they look to diversify their economy.
Hmm.
Being in Japan,
Hmm.
so the level of global capital going in Japan, it's increasing at a very material ways. In fact, there's 3 or 4 deals just announced today when I was looking at things this morning. So I think you're right. The percentages will certainly shift.
Cool. Okay. Want to change the subject before we wrap up this. And I want to think a little bit more about real estate in a couple of different contexts. One of them, in this global world, we have great cities. Cities go through cycles of excitement and challenge. And so if you look globally across the world's great cities, which are ascendant or descendant? What are the challenges? What are the consistent things that are working to make a great city even greater through these changing times? I know that's a broad question, but I'm hoping you have some wisdom towards that.
So look, I think it's a fascinating conversation to have. Maybe just starting here in the United States. I think people coming through COVID thought that the cities were going to be left to die
Probably why
because
I ask. Yeah.
people were moving to the suburbs. Now, I always had a view that that was probably a short-term phenomenon, and that when you think about some of these places like New York, San Francisco, Chicago, where I live, Washington, DC, Los Angeles, all these places, they have these enduring characteristics that underpin them that may, at various points in time cause mindsets to shift, but those enduring characteristics are always going to remain. So, for example, in New York, it's still the financial capital of the world.
Hmm.
It's still home to some of the best restaurants and live entertainment. You can't just pick up Broadway and move it.
Hmm.
Similarly, Francisco, gateway city from various parts of the world, proximity to some of the best universities in the world with amazing things to see. You can't just move those things. You can't move the Golden Gate Bridge. So yes, I think you'll see various points of time where certain cities like those fall out of favor, but over time, I think those enduring characteristics are what people focus on.
And add to the way you're looking at this. I'm interrupting you partway because I want the rest of this to include Copenhagen. I want it
Mhm.
to include London. I want it to include Paris, whatever the city, just so keep going, but have that in mind as Tokyo as you say this.
And so I look at it the same way when I move to Europe and I think about places like London, Paris, all throughout Germany, the Nordics. At the end of the day, these places have characteristics and a lot of history that are why people wanted to be there in the first place. And it's true for Asia too. I mean, if you go to Japan or Singapore or all throughout Australia and throughout, wider Asia, it's true too. And the Middle East is building that as we
Mhm,
speak. They're going through the next leg of their evolution, but at the end of the day, what they're trying to do is build what are their enduring characteristics. They want to they want to be destinations in the future versus just being places where people come to get money and then leave. And
mhm.
so when you look at the level of hospitality development that's happening in that part of the world, that's about creating these enduring characteristics. So I think that that's fundamentally what this is about and why I think cities will always continue to be part of the uh the opportunity set.
So it's interesting. Cities are our industry. So if we think of what our role is 70% of our industry sits in our cities. We create them, we sustain them, we build them, we evolve them. That's number one. Number two, COVID was not going to change 2,000 years of world history that is creating concentration in our urban areas. And nor will AI and the internet, because you can work from home, kind of change our cities as well. So the enduring draw and tourism will continue to go that way, right? People want to go see these places. So and I was
As
blown away by New York, but San Francisco scared me during COVID, really scared me.
Yeah, I think, and I think just for some, it still scares people as well. But I think that what's interesting is the level of the number of investors who are going back into, San Francisco today is at an uptick. You mentioned something a minute ago, and I want to make sure I commented on. I oftentimes hear that global tourism is not happening. I would say it's happening at very much accelerated rates. I
Mhm.
mean, every every conversation I've had this week with somebody, uh, was encompassed going somewhere outside of where they were physically situated for the holidays or over the next 6 to 12 months. And why is that? Is it gets back to, I think, the point that you mentioned a minute ago, is that these places have a lot of history and that people wanna see that. So, the degrees of tourism are always gonna go up and down. There's a lot of reasons why that happens. But at the end of the day, people are still gonna travel and it's on a global basis.
Yeah.
One final point on this is that, in some cases, some of that tourism is even gonna accelerate because there's actually an economic uh trade-off that people make where, for example, they can go skiing in Europe versus here in the
Mhm.
US at a more better economical picture. So there's a lot this is much more nuanced than I think sometimes it's made out to be.
So let's play with that for another minute, and then we'll hit a different subject. I want to talk about housing for a minute. So
Mhm.
think of Taylor Swift. I have a bunch of friends who took their kids to Europe for Taylor Swift, who saved money from seeing him in their home city or her in their home city. I saw Bruce Springsteen in Barcelona 2 years ago. It was like an amazing experience. And I'm the intelligentsia. I'm the upper one, two, three, whatever percent. But you go down to the top 40% or whatever it is, they want to travel. That part of what they need to do in their life with their kids, we're going to go to Paris before we're done.
Yep,
So travel will not end. And it's interesting because we think of deglobalization as a theme where US is retrenching, but at the same time, the world is 100% porous in terms of travel, in terms of technology, where the technology comes from. Those things are that direction is not leaving us.
100%. And I'm glad we're both Swifties.
I'm not a Swiftie, but I am a Bruce Springsteen-y, and I sat there in a, like, 80,000 person stadium listening to people from all over the world belt out my songs in English, and it
Yeah.
was at a moment of global discord, but hearing people from that other, and I'm gonna get teary-eyed to say that, hearing people standing next to people, raising their arms, screaming, yelling, hollering, singing every word, "Born in the USA," they're screaming that. They hate America, but they don't hate 'em. So it's incredibly complicated. It was one of the most moving experiences I ever had.
So what's interesting about this, Matt, is that I think this is oftentimes somewhat missed too. But these different, like when you talk about the arts
Mhm.
and entertainment, I'd put sports in this
Yep.
camp too. These all things actually bring
People
people,
together.
yeah. And so, is that part of the normal discussion each every day enough?
Mhm.
That's interesting, I think, to think about.
Cool. We'll do a dot, dot, dot on that one. Okay, couple other subjects before we wrap up. Housing. Housing is a global crisis. So
Mhm.
this is another theme that you would think might be US and the housing affordability issue, but it turns out it's the way in most of our world's capitals. Any comment on why that's a persistent issue across the globe, and then how different parts of the globe are addressing that so that it will become less of a persistent issue, get solved somehow?
So for sure, housing is a global crisis. It is a fact that there's not enough supply of housing. It just is. It's a fact, and it's true all over the world. And it's supply. It's a
Mhm,
supply. Why is it a supply issue? Some of it's due to the regulatory frameworks of some of the cities around the world, where they're not. The zoning requirements are complicated, and there's other kind of regulatory barriers that are present that create the issue. Some of it also is because of where the costs of construction are. Some of it's
mhm,
also just the ability. Like I just think about where I live in Washington D.C. There's not a lot of vacant areas to develop housing. Yeah, and so all those things together kind of create this economic question around: is it economical to build new housing that meets, the the consumers where they need to be met? The answer at the moment is no. And so you've seen, for example, a lot of construction happening at the upper end of the market, which is not really where you need the
mhm,
most supply. Why is that happening? It's happening because it's economical to do it for that part of the market. It's not economical at a different part of the market. So the question has been, can the federal government do something about this? Well, what I see and the conversations that I'm part of, for through various industry groups, is that the federal government doesn't necessarily view it as their issue per se, because they at the end of the day they can't control all these different cities. So the question for them, and what has already started to happen through like the Road to Housing Act of 2025 and the like, is how do you create incentives,
mhm,
states, cities, and local municipalities to produce construction in the right areas to solve the housing crisis, and in turn gain access to various federal programs that the federal government does have. And so, for example, the Road to Housing Act of 2025, sponsored by Governor or by Senator Tim Scott, introduces a number of pilots that are going to start, that are trying to see if this can ultimately be the long-term solution. So we'll see what happens, but that's where we are now. Oftentimes what I get asked is, do I think conversions of existing assets will
mhm.
meet the moment? I think the
A little
short
bit.
answer, on the margin, but not the overall issue. I mean, look, there's a lot of really good happening things in New York, a lot of good things happening in places like Calgary up in Canada, and other places around the world, but it's still not gonna be enough to address the issue.
And around the world, the challenges are similar because here, the federal government versus state government versus local government addressing housing is a challenge structurally, but the themes that you described as supply issues are global.
For sure.
Is climate an issue, and how do global investors look at climate in this next cycle of investing. How is that disappeared as an issue? Is it we given up on that issue? Is it as front and center as it's always been?
So, on the topic of climate and ESG, I think at the end of the day,
Mhm.
the way that investors look at this is it's a value creation question. And how does it preserve or create value? And so on the topic of climate, it is true objectively that we've had more climate related events happen around the world than we've ever had. And they're happening at an accelerated pace. Now we got lucky this year we didn't have a major hurricane, right?
We haven't had a major fire sitting here in fire country.
But over long periods of time it is true. And so what that's meant is that investors have faced higher insurance costs. And so investments in resiliency as a way to preserve value and create value through having a lower operational cost structure is going to be part of the equation. In fact, we did a study on this with our collaboration between our insurance business and our real estate business, where we looked at this very topic around investments in resiliency. And we think it's gonna happen because it's a value creation question. We look at other areas of like ESG the same way. If you think about energy savings and things like that, it's
Mhm.
amazing to me. In fact, I spent time on it a significant amount this week actually. It's amazing to me the amount of initiatives that are ongoing around creating energy just conserve and save energy because it has a cost implication.
Mhm. Mhm.
Sure. In some cases, it's amazing to me the amount of value that's being created. So I think
Yep.
that's where these 2 topics are. They sit in the value creation conversation.
I'll go there. It's funny. I never loved that climate and value creation, if they're related, became generalized into ESG and then equated with social subjects versus the climate subject and the environmental subject, which is quite specific for me.
Mhm.
And then in Trump world, it became a bad word to put them together. But the climate part hasn't much changed, and it might all be about longer term time horizon thinking and economics, as you've just said.
That last piece of what you mentioned, I think is really important too, and to maybe tie some threads together here. As the time horizons lengthen, as we talked about before,
Hmm.
that makes some of these conversations around climate resiliency more important
Yep.
because the mindset can't be, I'm not gonna witness that event during my time horizon, right? There's a much greater chance that it does happen, and so therefore it's more part of the conversation, and we see that I see it all the time in our deal processes, that thinking kind of making its way into the strategy part of the conversation for that exact reason.
I leapt to a funny place when you said that because you said, "Will it happen in my time horizon?" And I'm wondering if that's the investment vehicle time horizon or the lifetime horizon. Like my city's not going to be flooded while I live, so who cares? Yeah, it was very funny you said that. Okay, before the final question, is there anything we're missing since we've covered the globe in lots of interesting ways here? Am I not asking you a burning question that you want to talk about?
I just think that I think what I oftentimes what I reflect on is whenever you kind of pick up the the newspaper or look at the TV, there's a question around, is real estate's in significant trouble? And it's true to say that real estate is going through various challenges, particularly in certain sectors like office as an example. But at the end of the day, so is every other sector in the world. And the real estate industry has always been incredibly resilient and adaptive. And so I like to think of this as, more open, with kind of that optimistic lens that there's a lot of really good stuff happening in the industry. And there's a lot of really exciting things that are happening that haven't happened before that people can be a part of. I mean, I think of for example, what happened in the single family residential sector coming out of the financial crisis. I mean, I remember when people said like that's never going to be an institutional market. Now, arguably, it's been such a critical part of the housing dynamic, and we've got two scaled public companies in the sector. So
Right.
I think this optimistic lens is where I'd like to see kind of more of the focus. And we've talked about a lot of the reasons why on over the last hour or so.
Yeah, it's really interesting because I think time horizon's one of the themes of our conversation here. The newspaper looks it's like a deal book. It looks at today and boy, and then the thing today is the office market's in trouble, therefore real estate's in trouble, therefore the whole business is in trouble. We have some cities that have had like San Francisco, which there was going to be the death spiral in San Francisco. Luckily, the economy and things turned around here, leadership turned around, so it has changed. But the headlines are so exciting and enticing. But
Mhm.
you're absolutely right. When you put a long-term time horizon, the cities will come back, they will persist. The sector is incredibly resilient and always changing and expanding because definition of real estate or infrastructure-ish has moved a lot, as we've talked about here.
I agree.
So totally fascinating. Okay, the last question on Leading Voices is always advice for a young person getting into the real estate business.
So I love this question, by the way. And so what I would say is that the real estate industry is an incredible industry to be a part of. And the reason I say that is that it you intersect with the real estate industry all day, every day. You go to work, you go out for fun, spend time with your family, you go on vacations. You're intersecting every day with the industry. And I think that makes it incredibly exciting. And it's at the center of literally everything. So my advice would be to younger people is to take the time to really understand how this industry works from a commercial perspective and why some of these things are happening. I mean, you're always going to have your subject matter discipline. You may be a lawyer, you may be somebody like in my camp who's more in the consulting side. You could be an investment banker, so on and so forth. But at the end of the day, all these things intersect and operate together. And I think understanding that from a commercial perspective would be my biggest advice.
It makes a lot of sense. It's funny, part of the reason for this podcast, listeners, please listen here, but so my avatar is a young person who's in the middle of business school trying to think about a career in real estate and where do they enter and what might it look like. So that's one of the goals for the podcast. Half my listeners are leaders already and already in the sector, but others are entering. And think of the diversity of roles, the diversity of impact, the diversity of vehicles, as we've talked about today. It's global. You could do it anywhere. It's just fascinating.
Well, and I think just to make one more comment on this, because you made the point earlier, which I love and I agree with, there's also opportunities in real estate for non-real estate professionals because of some of what we've been talking about. I was on
Mhm.
just this week, in fact, we were trying to recruit somebody who started their career in the health industries field and wants to get into real estate. As all these things kind of converge and these other things become more important, there are, to your point, a lot of opportunities. It's incredible.
100%. Hey, Tim, thank you very much for taking time out of your travel schedules to be on the show. And I'm looking forward to this and our continued conversations.
Thanks so much, Matt. Appreciate it.
Thank you. I hope that you enjoyed today's episode. Please remember, if you're enjoying Leading Voices, to share an episode with a friend or get them to subscribe. If they're podcast wary and not sure how to find and subscribe on their phone, go ahead and take their phone in your hand and subscribe for them. And add another few of your favorite podcasts to their list to get them started. They'll thank you for it. You can also find episodes of the show on our website, which you can find at zrgpartners.com/leadingvoices. And if you have comments or discussion about this episode or Leading Voices in general, or if you're seeking help in real estate human capital solutions, recruiting or consulting especially, please contact me at mslepin@zrgpartners.com. Thanks for being a listener to Leading Voices.